A record number of Americans are now carrying credit card debt that they can't pay down.
Bank CEOs say that they are concerned about President Trump's call for a temporary cap on credit card interest rates.
President Trump reiterated his call to temporarily limit credit card interest rates.
Your bank just increased your credit limit. But what if that wasn't a reward and was actually a business strategy? This is Fiscal Forge. It arrives without warning. A notification, an email, a message inside your banking app. Congratulations. Your credit limit has been increased. For many people, it feels like good news, a sign that the bank trusts them, a reward for responsible financial behavior, a symbol of financial progress. And sometimes it is. But what if there was another reason? Because banks are businesses. And businesses rarely make decisions without expecting something in return. So when a bank voluntarily increases your credit limit, an important question emerges. Why? Why would a financial institution willingly expose itself to more risk? Why allow customers to borrow more money? And why do credit limit increases happen so frequently? The answer reveals something fascinating about modern banking. Because behind every credit limit increase is a business model built on one simple reality. The more credit available, the more money can potentially be made. Most consumers believe credit limit increases are primarily rewards. And to some extent, that's true. Banks often review payment history, credit scores, income levels, spending habits, and account activity. Customers who consistently make payments and manage accounts responsibly are generally viewed as lower risk. But risk is only one side of the equation. The other side is profitability. Credit card companies make money through several channels: transaction fees, interest charges, annual fees, merchant fees, and other account services. A larger credit limit creates a larger financial ecosystem. It increases potential spending, potential balances, and potential revenue. From a business perspective, increasing a customer's credit limit is often an investment. Not necessarily because the bank wants the customer to fail, but because the bank expects greater future activity, and greater activity often means greater profit.
A record number of Americans are now carrying credit card debt that they can't pay down. According to a joint report from the think tank, the Century Foundation, and the advocacy group Protect Borrowers, roughly 111 million people were unable to pay off their monthly balances in 2025. That represents half of all Americans who have a credit card and 40% of the population. It's a lot. In total, those cardholders carried more than $1 trillion in debt month to month, the report found. CBS News Money Watch reporter Megan Cirillo joins us now. Megan, it's always great to have you. These findings show that Americans were struggling with monthly credit card bills even before the war with Iran ran up oil and gas prices. Is this something that's going to push it over?
It could be the exogenous shock that pushes these same consumers over the brink. They were already facing higher prices in part because of tariffs. We also saw the expiration of Affordable Care Act subsidies, so some Americans were facing higher health care costs, and polling shows that they were doing things like skipping meals and delaying seeking out medical care because they simply couldn't afford it. Now, those same consumers are facing gas prices that are inching close to $4 a barrel, and $4, and that's pain they feel at the pump every single week.
That's something you can't get away from.
One of the most powerful effects of a higher credit limit has nothing to do with mathematics. It's psychological. Behavioral economists have long studied how available resources influence spending behavior. When consumers have more available credit, many naturally feel more financially comfortable. The emergency cushion appears larger. Purchasing power feels greater. Financial stress often decreases. And that perception can subtly change spending decisions. A person with a $2,000 limit may think differently than someone with a $20,000 limit. Not because their income changed, not because their savings increased, but because their access to borrowing expanded. The key word is perception, because financial confidence and financial reality aren't always the same thing. And banks understand this dynamic remarkably well. A larger limit doesn't force spending, but it often makes larger purchases feel easier, more reasonable, more attainable. And that's where the business model begins working. Studies in consumer finance have repeatedly found a relationship between available credit and spending activity. When limits rise, spending often rises as well. The reason is simple. Consumers frequently make purchasing decisions based on affordability, and affordability is often judged by available credit. A larger limit can encourage bigger purchases, more frequent purchases, and in some cases, larger revolving balances. For banks, this matters enormously. Every transaction generates activity. Every balance creates future revenue opportunities. And every increase in spending strengthens the relationship between customer and lender. Again, this doesn't mean banks are trying to create financial hardship, but it does mean their incentives are aligned with increased usage, because inactive credit generates very little revenue. Active credit generates significantly more.
Bank CEOs say that they are concerned about President Trump's call for a temporary cap on credit card interest rates. But getting lower credit rates may already be possible for many consumers. Sharon Epperson joins us right now with more on that. Sharon, good morning.
Good morning, Becky. President Trump reiterated his call to temporarily limit credit card interest rates in an interview with Joe Kernan at the World Economic Forum in Davos last week.
I'd like to see a one-year cap of 10% with the credit card companies. And they'd understand that. I've had calls from credit card companies, people that are friends of mine, actually, and I treat them good. I respect them greatly, but they make a lot of money. They got to give the people a break.
Improving affordability for American consumers is a shared stated goal among many bank CEOs, yet many also have concerns that imposing a blanket rate cap on credit cards would impede access to credit.
To understand why credit limits matter, we need to understand how credit card businesses generate profit. Interest remains one of the largest revenue drivers. When customers carry balances, interest payments generate recurring income. Merchant fees generate revenue whenever cards are used. Premium card programs create additional revenue streams. The system works best when customers remain engaged, using their cards, making purchases, maintaining accounts, and occasionally carrying balances. From the bank's perspective, a higher credit limit expands the potential size of this ecosystem. Think of it as increasing the size of a store. The larger the store, the greater the opportunity for business activity. The same principle applies to credit. A larger limit creates greater borrowing capacity, greater transaction volume, and potentially greater profitability. This is why credit limit increases are common across the industry. They're not random acts of generosity. They're often strategic business decisions. A higher credit limit isn't inherently bad. For many consumers, it can actually improve financial flexibility. It can reduce credit utilization ratios, improve credit scores, provide emergency access to funds. The danger emerges when available credit becomes viewed as available income. Those are two very different things. Credit must eventually be repaid. Income does not. And when consumers begin treating borrowed money as spending money, balances can grow quickly. That's when interest enters the story. And that's when financial pressure begins building. Many debt problems don't start with reckless behavior. They start with confidence. Confidence that repayment will be easy. Confidence that future income will cover today's purchases. Confidence that the balance will remain manageable. Sometimes it does. Sometimes it doesn't.
That's something you can't get away from, and you have to travel to get to work and such things. So in January, President Trump floated a proposal that would cap credit card interest rates at 10%. How could that help, and where does that stand?
The deadline, which he said at the time was January 20th, has come and gone. And at the time, it wasn't clear how it would be enforced anyway. There's bipartisan legislation that would cap interest rates at 10%, but the president has not officially endorsed it. The research that you cited a moment ago found that a 10% cap would be saving consumers $368 million a day in interest payments. That's the difference between what they're paying on those balances with interest rates hovering at around 22% versus what they'd be saving if interest rates were capped at 10%. Banks are opposed to such a cap. They argue that it would limit consumers' access to credit, and advocates for consumers say that these interest rates are a big profit center for banks.
The true cost of a larger credit limit isn't the limit itself. It's what happens if balances remain unpaid. Interest compounds, month after month, year after year. And over time, the cost can become substantial. The same force that helps investors build wealth can work against borrowers carrying long-term debt. This is where many consumers underestimate the impact of revolving balances. They focus on monthly payments, not total repayment costs. And that difference can be expensive, especially when interest rates remain elevated. Fortunately, a higher credit limit doesn't have to become a financial trap. In fact, many financially successful consumers benefit from larger limits. The difference lies in how the credit is used. They view credit as a tool, not income. They maintain low balances, pay statements in full whenever possible, and focus on long-term financial goals rather than short-term purchasing power. The most valuable benefit of a larger limit may not be spending capacity at all. It may be flexibility, the ability to handle emergencies without disrupting long-term plans. But that only works when borrowing remains controlled and when spending decisions remain tied to actual income, not available credit.
The average credit card rate is over 19.5% according to Bankrate. Still, many credit card issuers, including Wells Fargo, Bank of America, and Citigroup, already offer low rates or 0% interest on purchases or balance transfers, and often for more than a year. Consumers have a powerful way to get better rates right now, experts say, by improving their credit score. Taking these 3 steps can help. Make your payments on time, pay more than the minimum balance due, and don't max out your credit line. Also, keep tabs on your credit score on your bank or credit card app.
At first glance, a credit limit increase feels simple. The bank trusts you, your account grows, your purchasing power expands. But underneath that offer lies something much more interesting, a business model, one built around activity, spending, borrowing, and financial engagement. The bank isn't necessarily hoping you'll fall into debt, but it is hoping you'll continue using its products, because every swipe, every transaction, and every balance creates economic value somewhere in the system. Understanding that doesn't mean rejecting credit. It means understanding incentives. And once you understand incentives, you begin making better financial decisions. Because the most important financial advantage isn't having access to more credit, it's knowing how to control it. Every week, we uncover the hidden systems behind banking, debt, credit cards, investing, and personal finance. Because the biggest financial stories aren't always found in headlines. They're often hidden inside the products millions of people use every day. And understanding those systems today could help you make smarter financial decisions tomorrow. If you enjoyed this breakdown, subscribe to Finance Decoded